What's up, my fellow wealth creators? Matty Guys here. So today I'm really excited to share with you the actual results of my first cash value whole life insurance policy. We're gonna compare parts of the original illustration with a current in-force illustration, so you can see the numbers and just break down how it's outperforming the original illustration, which is obviously really, really good. So I've entered the third year of my first policy. About to enter the third year of my second policy. They're both outperforming. They're both doing really well. And I want to break down why that is the case. Why are they outperforming? And then I'll finish up with some specific ways that I'm using my policies to help accelerate the wealth building process in my life. That's the goal. All right. And also, just so you guys know, I just completed my free whole life insurance mastery course. I will link it down in the description below, and I'll put it to the top comments. Make sure you guys get that. It's 5 lessons on everything you need to know about cash value whole life insurance to help you determine if it's a good fit for you. So make sure you check that out. All right. So this is what you're seeing here is the original illustration for my first policy. And what I want you to take note of, hopefully you guys can see my cursor here. I'm not sure, but in the column where it says net cash value, see that third number there, third number down, $168,381. That's what my net cash value was projected to be by the end of the third year based on the dividend rate at the time of this illustration. So about 3 years ago, and this was with Lafayette, their dividend rate was 5.2%. Well, it's 5.9% now. So we're going to see a pretty big difference here when we go to the next slide. This is a current in-force illustration. And the top column is actually, you can kind of see it there. It's the third year. So the first number for the net cash value right there is the third year. So by the end of the third year, what do you see? It's quite a bit ahead. 170,000. It's projected to be around $170,354 based on the updated dividend rate right now, which, like I said, is 5.9%. So it's like $2,000 ahead already, which, in the grand scheme of things, that's not like huge, massive outperformance, but that's going to build on itself over time so that my policy continues to outperform pretty significantly the original illustration. And that outperformance is going to get better and better and better and better over time because of this. Right. And what's really neat about this too, guys, is this is actually my break-even point now. So for my first policy with Lafayette here, I was on track to break even between years 3, probably by the end of year 4. But now I'm set to break even by the end of year 3, which is freaking awesome for whole life insurance. I mean, usually with cash value whole life insurance, if you can break even between years like 4 and 6, maybe 7, that's good. It's like average. So by the end of year 3, breaking even, I'm pretty happy with that. And for those of you that are new to this, what I mean by breaking even, I mean I have access to the same amount of cash value or more than what I've paid in premiums into the policy. So I've paid in $170,000 so far. By the end of this third year, I will have access to over $170,000 in cash value. That's pretty sweet, man. Not bad at all. Let's go through let's go through how this has impacted the internal rate of return of the policy. So this was the original one. My original net internal rate of return over 30 years would be 3.93%. So just under 4%. Over the life of the policy. It doesn't mean it starts earning around 4% after 30 years. It's as if it earned a net internal rate of return of 4% the entire time of the policy. That's how these things work. All right, so the original was just under 4%. Is that sexy? No, but I'm not trying to chase like super high returns with my safe money, with my safe assets, right? I consider this like a bond alternative, an alternative to savings accounts and CDs and money market, treasury bills, whatever. Right. So 4%, which doesn't even take into consideration the tax advantages as well. I'm pretty happy with that. So I am absolutely happy with the updated internal rate of return right now at 4.53%. So it has made those dividend increases have made a significant difference in the performance of my policy so far. So again, is that like a super sexy return? No, but for a safe place to save and store capital long term that I can also use that capital to invest and build wealth at the same time, I'll take that. And we'll get to how I'm doing that here in a minute. So let's break down why my policies are outperforming here. Well, at the end of the day, it's the dividend rate. That's obviously a huge part of it. All right, so The original dividend rate was at 5.2%. It's currently at 5.9%. And I'm actually anticipating it to stay somewhat higher because what I'm noticing is that even though as I record this, the Fed is lowering interest rates, but the 10-year Treasury yield is actually going up. So while they might be able to control short-term rates, it doesn't seem like they have much control right now at the longer end of the yield curve. So what that means for policies like this is that they're likely, the dividends are likely to stay higher. I don't know that for sure. Okay. But since these mutually owned life insurance companies primarily invest in AAA corporate bonds and treasury bills, and like it's basically a big bond portfolio, their general fund, where they take a portion, a large portion of our premiums, they invest it very conservatively, primarily in bonds. And so if those if the yields on those bonds remain higher, then it's likely that the dividend rates will remain elevated as well. So it's like right now, it's just a stronger fixed income environment. And these dividend rates typically track Moody's AAA corporate bond index pretty close. Usually they're a little bit better, like maybe 50 basis points better when it comes to the dividend rate. And I checked this on January 29th, 2026. The current Moody's bond corporate index, whatever, is 5.37%, which again leads me to believe that we'll likely see these somewhat higher dividend rates. And then also it basically boils down to better than expected investment performance as well. So obviously if the general fund experiences better than expected investment returns, they can increase the dividend rate, which gets passed back to the policyholders. So contrary to what people like Dave Ramsey say, where they're just, a dividend is just giving us our money back. No, it's more to it than that, pal. You participate in the profitability of the company, including the investment returns of the general fund. Right. So the better they do in their general funds, the higher the dividend rate, the better our policies do. Plain and simple. Right. So like I said, is 4 to 4.5% internal rate of return something to get super excited about? Not really. Like I get excited when I do real estate and income ETFs and Bitcoin and stuff like that when it comes to rate of return. But we don't set these policies up for rate of return, guys. Like if we want to try to get the highest internal rate of return we can, I think that's important. But that's not why we set this up. Like my money is not just stationary and idle in these policies. I'm actively, not that there's anything wrong with that. You don't have to use your policy all the time, but I'm actively borrowing against my policy to make investments in real estate. And, I'm accumulating a nice portfolio of income ETFs right now and stuff like that. Right. So, this is, while it's not a super sexy return, here's the thing, what compared to what, right? Because the way I see it, especially since this doesn't even take into consideration the tax advantages, you have the death benefit, creditor protection, chronic critical terminal illness riders. I don't know any bonds, like corporate bonds or bonds at all, that offer any of those benefits. And yet we get a very similar internal rate of return. So it's like it smokes bonds and savings accounts all freaking day. We just get so much more benefit, right? So what else? Yeah, no market volatility, no contribution limits. Death benefit continues to increase every year. So it's not about chasing returns, guys. It's really about building that financial foundation that's going to grow with us for the rest of our lives, be there at every stage of our financial journey, and help us accelerate the wealth building process, period. And it's also about giving our dollars multiple jobs too. All right, so let me break down really quick how I'm using my policy. So obviously, really excited that they're outperforming, but another aspect of that is, as they outperform, that means my cash value grows more than expected. That means I have more cash value available to me to potentially put to work, right? So I'm still investing in real estate, specifically through private money lending. Should have another deal coming up pretty soon. I've done 3 deals so far. They've all been really, really good. And so that's like the primary way that I'm using my policies to build wealth. Although, like I mentioned, I'm considering at some point potentially using it for income ETFs. I'm just working out a few scenarios and like how I would want to pay the policy loan down and all that. All right. But why would I do that though? It's because this allows me to build wealth in 2 places at once. I would then have 2 assets that are growing over time. One of them is an income producing asset. So the question is, does it make sense for me to borrow at 6% borrow against my policy at 6%, and then lend it to my investor, my real estate investor, at 13% plus a point or 12% or whatever. Well, yeah, I would do that all day long. Banks do that all day long. They pay us 1% on our savings accounts and then lend it back to us at 4, 5, 6% for the car loan or the mortgage or whatever. So basically, I'm just doing exactly what a bank does. If it's good enough for a bank, why wouldn't it be good enough for me? Right? Same thing with the income ETFs. Potentially. Now, the downside to this is that there's more price volatility, obviously, because these are like stock market types of assets, I guess you would classify them as. But they could still generate really good yield. So again, if I borrow at 6% and I put that into a NASDAQ 100 income ETF that's yielding 13 or 14%, that's a pretty big spread. And I can use a portion of that that yield that I'm earning to pay back the policy loan over time. But now I have my income ETF that's building wealth, and then the cash value in my policy continues to get that uninterrupted compound growth at the same time. So building wealth in two places at once. The only cost of doing that is the policy loan interest, which is peanuts compared to the wealth you'll build over time by doing it in two places at once. Makes sense to me. I've also been using my policies for debt consolidation. Not for me. I don't have any debt. It's freaking awesome. If you guys aren't there yet, you will. I know it at some point, and it's amazing. And so I'm trying to pay that forward a little bit as well by helping people in my social circle, people I love and know and care about, helping them consolidate their high interest credit card debts. And then they just pay me a certain interest rate, they pay back the policy loan, but my cash value continues to grow over time. I've done videos on the specific examples, but that's another great use case of these policies, guys. All right, vehicle purchases. I don't plan on purchasing a new vehicle anytime soon, but if I were in the future, at some point in the future, then I will absolutely be using my policy. Obviously, it still maintains or it continues to be my source of emergency funds. So if something major comes up, and then long-term capital storage is just how I think about these policies, guys. All right. And actually, I like this at the bottom. The money is never locked up. I can access it at any time for whatever I want. And even if I don't, it's still providing immense benefit for me, right? So I'm currently, I just did a video the other day about the 4 stages that you typically go through as a whole life insurance policy holder. I'll link that down below, or if you guys want me to send it to you, just drop a comment. I would definitely recommend it. It basically goes through the different ways that we're able to use our policy based on how much cash value we have and how that grows over time. Right now, I would put myself in stage 3 and 4, where I'm using my policies as a wealth acceleration tool, a wealth building tool, whatever, and then also some legacy planning too. I finally got my trust in place. My trust is the beneficiary of these whole life policies, and then I have very specific rules and basically my wishes on how I want the death benefit to be used, which is to purchase whole life policies on my beneficiaries so that they can rinse and repeat the process. It's freaking amazing what you're able to do. Right. So, but using policies at this stage, you're typically using it as like capital investment engines, leveraging the cash value without interrupting the growth. That is so freaking powerful, and you're able to build a massive long-term legacy. Right. So yeah, that's it. I'll go ahead and wrap up with that. I hope that was helpful, guys. I just wanted to share the performance of my policies or one of my policies anyways, and how I'm utilizing them, why it's outperforming. And yeah, again, just another reason why I think these things are an incredible an incredibly powerful financial foundational asset. We'll call it that. So anyways, I hope you guys are crushing it. I will talk to you in the next one. To your success. Matty S is out.